Hello, it's Guy Costin, and I'm so excited to introduce you to Dakota Live Podcast. If you love Dakota Live and our allocator interviews, you're going to love the Dakota Live Podcast. It's hosted by Robert Moyer, one of our investment sales professionals, and the allocator. And just like on Dakota Live, in those interviews, we ask them all the pertinent questions about themselves, their platform, their searches, go really, really deep so you can get a deep understanding of who they are, what they do, and their platform. If you haven't had a chance to get caught up on Dakota Live Podcast, now's your chance to do so. You can do it right now on Dakota Marketplace, Spotify, or iTunes. You're going to love them. Welcome to Dakota Studios, the premier location for all of your video production needs. Our studio is located in the heart of Center City, making it easily accessible for companies of all sizes. Our professional production team is dedicated to creating high-quality videos that showcase your products and services in the best possible light. We understand the importance of video in today's digital age and are here to help you take your business to the next level. Whether you need a video for your website, social media, or to showcase at an event, we have the expertise and equipment to bring your vision to life. Don't miss out on the opportunity to showcase your brand and products in a dynamic and engaging way. Contact us today to schedule a tour of our studio and discuss your next project. We can't wait to work with you and help you take your business to the next level. What's up, everybody? Welcome to the Emerging Manager Growth Show. My name is Guy Costin, founder, CEO of Dakota, joined by my colleagues, our president, Danny Domenico, and our head of institutional sales, Tim Dolan. So welcome to the show. Guys, can't wait to get started. This is a very different format, so welcome.
Thanks, Guy. Thanks for having us.
And by the way, everyone, thanks. Our studio team was really flexing their muscles there. For those of you that have been involved with us for the past 2 years in Dakota Studios, Dakota Live, the Growth Show, all the stuff. Our team down here has really upped their game. It's really impressive. So thanks so much for just watching this couple minutes there. So today, let's go through the format of the call. As you all know, this call is dedicated to emerging managers for one reason and one reason only. Emerging managers are forced to do more with less, right? And we need to debunk myths. So number one, questions in the chat, it's on the right side of the screen. Fire away. You're only going to have us for about 10 to 15 minutes. We have 10 minutes on the front end. The reason being is, consistent with the show, we have Eric Shea interview from Bivium, unbelievable interview. We thought it was really a good use of time to show you that interview, help you understand a number of things. We'll recap at the end. We'll have a very short ending, but we're going to spend about 10 minutes now really hitting on some key topics. So number one, we're just going to start chatting, if you will, and please fire in the questions of what we've seen in the first quarter from a fundraising perspective. We're going to run a little video for me. It's called a fundraising pep talk that I shot last week because everyone's really caught up right now on how hard fundraising is. And obviously, the past 10 years have been pretty easy. I think it's sort of back to normal from what we've seen. But let's get into it because, Dan, why don't you start? It's been a very active first quarter for us. There's been a lot of allocations. We've definitely seen a little bit of outflow, so I don't want to say that we haven't seen outflows for our Edgewood Mutual Fund, but importantly, we're seeing there's a lot of money in motion.
For sure. I think that's been a takeaway for us, reflecting on what occurred in 2022. Obviously, there was a lot of events, there was a lot of turmoil, a lot of volatility. Not that we haven't seen that here in the first quarter. I think the key takeaway for us, and we remind ourselves of this every morning, so as a sales team, we talk every morning. We talk about the basics, like what should we be focused on? Because had we not, all that money in motion, we wouldn't have been a part of it. Which basically means the basics of city scheduling. I know we talk a lot about that on this program. We talk a lot about that in our Dakota Live call. That's why we go through the various metro areas. We remind ourselves of that every day. Are we scheduling for certain cities? Are we making those calls? Because it's so easy as sales professionals to have excuses. There's a lot of noise going on, whether it be the latest banking crisis that we've all had to endure. So I'm not going to make the calls because there's so much going on in the marketplace that the people I'm calling won't be taking my call. They won't be taking my meeting.
So let me ask you this, Tim, just get into it a little bit. Are we getting meetings, which is a softball question? Okay, are we getting meetings? Are we seeing finals presentations, and are we seeing allocations? Like, is money in motion?
Yes, definitely money is in motion. We are getting the meetings. We are, as Dan talked about, city scheduling, right? So at any point in time, we have 5 to 6 cities on the books, and those are filling up. I think what we're seeing, right, is allocators are starving for interesting, unique ideas. Fortunately, emerging managers, for the most part, have those strategies. So they actually want us to call them and get on the road and go meet with them. So we're seeing meetings happen. Yep. We're definitely seeing searches happen, right? We see it every single day in the public pension meeting minutes. We see it with the search activity through the consultants or the direct pension foundation endowment. I mean, we're probably getting, 2 to 3 searches a day sent to us through Dakota Marketplace. So there's a lot of searches, and that's across all asset classes.
Because if you think about like what occurred last year, because of all that volatility, there was a buildup in cash or cash surrogates. Those are placeholders for future allocations. Depending on what your view is and outlook on rates, I know there's a lot that would say that we're at the later innings of this rate cycle. So if you expect rates to then come down, those allocations to those either treasuries or to cash, that's going to move somewhere. Right, so that's where these searches are all about right now.
Share some anecdotes, because you told me last week you're on the road. We talked a lot about the people that had to sell out of Edgewood in the fourth quarter for tax loss harvesting purposes, and then we're going to come back in. Yep. Share that story, because I think for our audience that there's just so much negativity out there right now.
And sentiment's not great.
Right.
Yeah. Sentiment's not great.
But I also mean from a fundraiser's perspective, we're hearing a lot from our customers, a lot of people we work with. Hey, it's really tough. It's really hard. And of course it is. It's just not coming off of what we did. That doesn't mean we should stop selling.
Correct.
Then talk about what you heard about backing up with a truck. I mean, people they're preparing to allocate.
Multiple meetings I had last week, the takeaway or the conclusion, if you will, was that we're waiting for that time within their own conversations, within the internal investment committee meetings. What they're discussing is the when to pull that trigger, to allocate back into equities, to allocate into private credit. When is that event that they feel as though, and they feel comfortable moving in? So one of the comments was, we're sitting here, we've got cash, and when it's time, when we feel better about the environment, we are going to load up in a given strategy, right? So you have to be in those conversations now, because that's what's being discussed around those investment committee conversations. Around the table right now, they're talking about when it's time to deploy that cash, where are they going with it?
And you need to be in front of the buyers, and that's the key.
Exactly.
Well, one of the messages today, I'm going to run a short video that I did last week, but before we do, the key point we're making here is that if we get caught up too much in this, it's hard, and then we're not getting in front of the allocators like we need to be, when the time comes to allocate, you might not be part of the conversation. And so it's our job on this show to tell you, as an emerging manager, right, do the meetings, send the emails. As you all know, we have a very tight format on emails you need to be sending. Clean subject line, meeting request, date and time, 1 sentence, maybe 2 max, clear call to action. Can you meet May 21st at 3 p.m., right? We always want to talk about that email. There's more to come on that if you want it from us, but we're big believers in the 3 elements to an email to get a meeting. And Tim, let's just talk about it, right? I mean, you guys, I've watched it. The team has been ardent about getting on the road, seeing investors. We've been able to get the meetings we want to get, and then the flow is there.
Yeah, and it's the city scheduling we've talked about, the 5 to 6 on the calendar at any given point, but it's that continuous process, right? If you hit Chicago in March, you need to be back there in June or July, and then in September and October, and it's just a forced mechanism to cover these accounts. And one thing that we're starting to notice within our own activity, right, is we track first-time meetings and follow-up meetings. I would say we're probably averaging 2 to 3 first-time meetings on a daily basis, which that makes us feel very positive about fundraising, to that point of people are willing to take meetings and learn about new strategies. So of course you're going to cover the pipeline and the people you know and your best relationships. But when you get that 3 meeting day in Chicago and you got 2 open time slots, that's where you can get the new. And that's the fun part about it. And you get a full day, and it's.
But we emphasize that in our business.
Yeah.
You have to emphasize that in your day, because it's too easy to get caught up in just the follow up, the existing relationships. You have to dedicate a portion of your day to go mine the new.
Yeah.
So, outside of putting water on the burning building, which would be your client service, explaining performance, all of that, if you're on this show and you're listening and an emerging manager, your number one priority has to be sending out those 20 to 25 emails, preferably in the morning, to try to book up those meeting slots. So we wouldn't be doing our job for you as you're listening if we weren't saying that. I know it's hard work, you can get distracted, but if you do that and you do it consistently, when people don't get back to you, it's not as emotional, right? As I said, I wish they could just invent, a pill you could take and it would erase any emotion you have from people not returning your emails or phone calls. It would be a lot easier, but unfortunately we don't have that. You just got to grind through it. But kind of the theme.
We did get one question come in. When do you bring the portfolio manager into the meeting versus a salesperson into the conversation?
All right. You guys are the pros. Let's talk about
it. Using a portfolio manager is a great strategy. We've constantly used that as a spear to get a meeting. Now, there's a couple different ways that you can go about this. On one hand, you can line up those days, say the portfolio manager is going to be in town. You yourself can be there in the meeting, and you can always zoom in a portfolio manager if they can't be there in person. Second, I would say having a portfolio manager there in person and dedicating certain days for travel with that portfolio manager and having a regular cadence for that, assuming your portfolio manager will travel with you, is very important. It's a core part of our strategy. But we do schedule meetings for ourselves. So we have Dakota days, as we call them, where we'll go out and we'll do all that profiling. We'll go and qualify what those leads are to then determine whether or not it's a meaningful trip and future meeting for a portfolio manager. Yeah. So we do it on parallel tracks.
I think also importantly is, reaching out cold to a pool of capital you don't know and say, hey, I'm going to be in town with a PM, and they say, yes, awesome, book the meeting. Right? The worst thing you want to have happen, you go do the meeting, and they're like, we don't invest in your asset class, and you're with the PM, and you're like, oh my God, why did we do this? So prior to that meeting,
got to qualify the meeting, for sure.
So prior to that, what we like to do, and personally what I do, is say, hey, given we've never spoken before, can I get 5 minutes of your time just to quickly discuss Edgewood or Hamlin or whoever the PM is going to be traveling and learn about their business? And that's where we can kind of set up the meeting before the meeting, right, and make Edgewood look really good, but also learn, how do you allocate to the space? Are you active or passive, or do you use liquid or illiquid if it's on the private side? So you can ask those qualifying questions before, so then you can have a much worthy conversation with the PM.
And I want to share with everybody a conversation I had yesterday with a 20-year allocator who's now moved over to a real estate firm. And I asked him a question. So he was 20 years on the allocator side. I haven't told you guys this yet. So we're really big on finishing a meeting with a PM in the room of asking the 2 hardest questions as the meeting concludes. And so I looked at him, super guy, and since he's brand new into sales, 1 year in, I was just sharing some war stories of things that he should be thinking about, right? That since he came from the other side, phone doesn't ring, right? And he was really cool about it and the whole thing. So I said, how many meetings do you think you've done with investment sales professionals over the course of your 20 years? He said, probably 10,000. Okay, so I said, how many times did the salesperson ask these 2 questions, or a variation of the question? If it's a private equity or private strategy, it would be you close the meeting and you simply say, hey, we've had a great time. Enjoyed getting to know how you guys think about allocating capital. You got to learn about our strategy. Just curious, is this a strategy that you would allocate to within your portfolio? It's this type of strategy, right? So a lot of times they'll say no. So let's say they say no. Now you know where you stand. And by the way, it happens more often than you think. Number 2, if it's long only, you would say the same thing, but the second question you would ask is, okay, we have a final close on 9/30/23. If this is a strategy to allocate to, could you make it into that close, or 12/31, whatever it might be? And then you pause and you listen. And that generates all of your follow-up. So if they say yes to both, now you're hopping, right? You're not going back to the office and saying, hey, how was the meeting? Oh, it was a great meeting, it was awesome. Okay, like, where do we stand? What's the next step? If it's a long-only strategy, then you can say, hey, do you anticipate doing a search in the next 12 months? So I say this to the gentleman on the Zoom call yesterday, and I said, how many times have people asked you that question? He goes, handful. So the reason I bring this up is we're all here not trying to waste each other's time, right? And if you do that, someone said to me, what's your follow-up cadence after a meeting? I said, well, I don't have a follow-up cadence. All I do is listen to the buyer, what they told me, and ask them those two tough questions. So if they say they can invest in the strategy and they are doing a search in the next 12 months, I already have the follow-up, and I've probably booked the next meeting in the meeting because it's probably going to involve someone in their office. So if you're an emerging manager and you're scared to ask that question or whatever, you got to get over that fear, because you're looking for, the best advice I can give in fundraising is the goal is not to raise money. The goal is to get the quick no's. If you get the quick no's, you can move on to the yeses, focus on the yeses, and that's where all the magic happens. So just a little, coaching, if you will, the things that we've learned, lessons learned over 25 years. It works like magic, but as we know, people aren't doing it. And so what ends up happening is you get back, you don't know why he's not getting back to you after the meeting, right? Well, you didn't ask them, there's no interest, unfortunately, even though they might have loved the strategy. So with that, do you guys have any, we're going to kick in to just one brief video that I did last week. I call it the Fundraising Pep Talk. I think this is really relevant because I keep getting questions and people saying how hard it is. And so, Jamie, do you just want to roll it? I think it's about a minute and a half. What's up, everybody? It's Guy Costin, founder, CEO of Dakota, and this is my Fundraising Pep Talk for 2023. I'm hearing a lot of chatter from friends, colleagues, customers, how hard fundraising is right now, how difficult it is. And if you're in private equity, you're reading the Wall Street Journal yesterday, the private equity allocations are going down. You have the denominator effect. You have all of this noise in the marketplace, right? Despite that, right, people are allocating capital. If you subscribe to our public pension fund minutes, you'll see there are an enormous amount of commitments, and it's still happening. There's no doubt, based upon 300, 400, 500 different public pension funds, they're all going to have maybe just a little bit of different approach and flavor of what they're going to be doing from an asset allocation standpoint. That doesn't mean that we shouldn't be making sales calls, finding alternative allocators, if you will, whether it's RAs or family offices or banks or broker dealers, depending upon where you focus. I am telling you, every day is a great day to sell. Or somebody just asked me right now, are you guys having any success? Well, the past 15 years, we've laid all of these lines in the water. Our goal from day one, and I would encourage you, is always just to have as many lines in the water with people to buy what you sell. And so when it rains a little bit, you get a little bit of money, if you will. If it rains a little bit more than that, you get a little bit more. If it rains a lot, you get a lot. The toughest part is having only a handful or a small group of investors that you're connected to. The goal is get out and cover all the accounts. If you're in private credit, I believe, and I think conventional wisdom right now is saying it's going to be an unbelievable time for private credit because of the bank crisis, right? They're not going to be lending as much, so you're going to have to go to these alternative lenders, which we know we have so many private credit managers on our platform, and there's so many out there, and it just continues to grow. So this should be a great time to be out in front of investors. So the pep talk is, I know it's tough. There's no doubt it's a lot tougher than it was in 21 and 20 and 19. We all lived through it, a little bit more free money. But that doesn't mean just because it's harder that we shouldn't be out making our calls, covering our accounts, building new relationships, city scheduling, doing all of that. So that's what our team is doing very, very aggressively. And it really is working. And we're seeing allocations being made, both equities, fixed income, private credit, private equity. We are seeing allocations. And I think you definitely see it if you're on our public pension fund minute. So with that, love you all. Signing off. Good luck. Have a great day. All right, there you go. There's the pep talk. Actually, it made me feel pretty good that we're cranking. We're getting out there. So before we kick into the interview with Eric, this is a spectacular interview for an emerging manager. This is a must-watch. And by the way, we've rolled out with Robert Morier this whole podcast series. It's really cool. He does a great job. He's been able to source some unbelievable allocators and interviews. So I encourage you guys to watch that. But any closing comments before we kick it over to Eric and the interview with Eric?
Nope. Should be a good one.
Great. All right. We'll see you all after the interview.
So Eric leads the private markets manager due diligence, portfolio construction, and asset allocation process at Bivium Capital Partners. Bivium Capital, a Black-owned and led performance-focused, mission-aligned investment management firm, has operated for over 20 years focused on values-aligned investing and sourcing diverse emerging managers. West Fuller Advisors, Bivium's strategic partner, is a Black, woman, and LGBTQ-owned wealth management and investment advisory firm providing bespoke investment solutions for institutions and families seeking meaningful social impact and financial returns. As strategic partners, the firms offer outsourced chief investment officer solutions for some of the country's leading purpose-driven institutions, targeting authentic, mission-aligned investment services. Eric, thanks for joining us, and congratulations on all your success.
Thank you. Thank you.
Can you sometimes imagine how quickly it's all gone? You're 22 years into the career now. How does it feel sitting in your seat today, looking back on the start?
Yeah, you know what? It's when I started out my career, joining Cambridge out of college, certainly couldn't have imagined doing what I'm doing now, right? I think, especially when you come out of college, you don't really know the industry, right? Maybe you have some exposure to what investment banking is, but just really don't know how disparate the asset management or financial industry is until you actually get into it. So, for me to be able to do a job now where I believe in a mission and investing in impactful managers really is a dream to me.
That's great. Well, we're going to talk a lot more about that mission and the work that you do with emerging managers. But it was interesting. So coming out of Cambridge Associates into Northern Trust, you launched and co-managed 2 emerging manager strategies in international equity and multi-strategy fixed income. There were only a handful of emerging manager programs that go back earlier than 2005. So you were really in the early innings of the emerging manager programs. Well, what was the impetus for Northern Trust to allocate to emerging managers at a time when arguably everything was working in the market? So you were looking at emerging managers. How did that assignment come up for you?
Yeah, and that takes me way back to a fun part of earlier part of my career. And I think that, like you said, the markets were doing very well and kind of ripping at that time. And it was just exciting time to be in finance in general. But when I first joined Northern in 2005, I think there was actually already a dedicated emerging manager business, managing portfolios for corporate pension plans, municipal pension plans. But they were all 100% or primarily U.S. domestic focused, and consistent with just a broader outsourced CIO business, and just portfolio construction trends at the time. Northern's mainstream OCIO clients were trying to reduce our U.S. home bias, and we thought, why shouldn't we do that with emerging manager programs as well? So as it happened, we did have a existing client of Northern's who was willing to take the leap of faith with us. And so we launched an emerging manager international equity portfolio with them. And that municipal pension plan, I think, is one of the most thoughtful investors out there and continues to be one of the most thoughtful investors out there. And I would say similarly on the fixed income side, we saw this, again, as kind of like a natural extension of what we were doing with our domestic U.S. equity emerging manager programs. We even had to come up with some of our own definitions because it was relatively new, come up with our own definitions of what emerging was in the fixed income space. And I think we came up with sort of 5 billion as the, back then as the sort of threshold for a firm qualifying as or being classified as emerging. And the reason why is that, I think in the fixed income space, as you all know, scale is pretty important. And even back then, 10, 15 years ago, the fixed income side was really dominated by the large, like the PIMCOs of the world, the TCWs of the world. So I think, it was a really exciting time to kind of build this new product at Northern Trust, working with my colleagues, John McCarrans and Luis Diaz. And then portfolio construction was actually particularly exciting because we were actually working with managers to customize strategies for our emerging manager program for this fixed income strategy. We even added credit exposure. We even added a little bit of EMD exposure, which was not typical for a Lehman Ag or Barclays Ag type of strategy at that time. So it was it was exciting to launch those 2 strategies at Northern.
That's great. We're going to talk more about how you define emerging managers. It's interesting to hear the historic perspective, particularly in fixed income relative to equity. So that $5 billion threshold for a fixed income mandate, it makes a lot of sense, particularly as you describe the scale. But your last 6 years at Northern, you actually spent those as a client investment officer. Can you share what you learned from your time working directly with clients in regard to customizing those investment solutions and portfolio construction? It sounds like you may have been able to take that forward as you're sitting in your current role today, but the client side of the business is something we don't talk a lot about, but we're obviously focused a lot on.
For me, I think there were so many lessons that I learned during that time as a youngish client investment officer, leading these client relationships that have folks at varying levels of sophistication, right? Some were on the cutting edge of the markets and market theory, like some of the corporate pension plans that had internal investment staff. But I also worked with investment committees at pensions and foundations and endowments who were led by really smart individuals in their respective careers. For example, lawyers, heads of nonprofits, airline pilots. But these were folks who weren't investment professionals per se, but they were well informed about the markets and knew how to ask the right questions. So I'll just highlight a few lessons that I learned during this time. Some aren't necessarily directly related to customizing investment solutions and portfolio construction, but I do believe that they were instrumental to actually building the trust between the client and I so that we could actually implement portfolio construction and manager changes. So I think the first thing is, just act as a fiduciary for your client. And I think that sounds like it should be table stakes as an OCIO or advisor, but I think that we all know from being in this industry for a few decades that no matter what organization you work for, whether it's a large or small organization, there are always internal pressures that might steer you towards one investment strategy or another, right? So I'll just give you an example. When I was a client investment officer for a multi-employer plan, and one of the first items on my agenda when I took over the relationship was just that I recommended that we, when I looked at the lineup, I just recommended that we swap to a cheaper but substantially similar strategy that was managed by a third-party firm rather than internally managed one. That was significantly more expensive. I think just this simple move, helps, this simple recommendation just helps earn the client's respect and that you are looking out for them and their participants. I think related to that too, I think the second lesson I learned is really listen to what the client is telling you. I think whether it's they're trying to ascertain, what kind of impact goals that they have now, what their impact investing priorities are now, or a client who's just more on a conservative side and is worried about market volatility and benefit payments. I think in each situation, you just want to make sure that you are structuring the portfolio and picking strategies that's going to meet the client's needs and help them sleep better at night. And so I think for me, once I built up the trust with the client from these recommendations and actions, it was just a lot easier to get buy-in and implement changes in portfolio construction and managers. I would say another lesson, or maybe just a experience as a client investment officer early in the last decade, that also really just planted the seeds for sustainable and impact investing for me. And to be honest, has led me to where I am in my career now. I was assigned to Northern's London office. I was overseas for a couple of years to work with a 25 billion euro pension plan. And that's where I first had a client ask me about ESG strategies. And coming from the US, none of my clients had been asking about ESG strategies at all, or even wasn't even on the radar screen. And I quickly had to get up to speed on it. I had to work together with my manager research colleagues. And just I learned more about ESG and the factors that it's trying to assess, the more I thought it just made sense to me. So, I thought, why wouldn't you want to consider these factors if you are as part of a holistic assessment of a company's operations and management, right? So, and just for me personally, in addition, I think my wife and I, we are, what we call aspiring minimalists. So sustainability just really makes a lot of sense to us. And then more recently, we have a 4-year-old daughter, and obviously you want to leave the planet and just the the work environment a better place for her generation and others. So I think that really those are kind of the main lessons that I took kind of from my time as a client investment officer.
No, that's great. I have a 6-year-old. I'm writing down aspiring minimalist right now because I am acquiring toys at a breakneck speed, and it's mostly due to my visits to Target. So that's really helpful and very interesting. I mean, you touched on mission and impact, and I know from Northern Trust you carried that into Cornerstone. You were responsible for sustainable and impact investment manager research. And I think it's it's a great observation that Europe was ahead of the curve in terms of integrating ESG and sustainability into their models. And I think the United States, we could say, is comfortably caught up. But one of the areas that I'm always curious about is on the private market side, and the alternative side of the asset allocation discussion as it relates to sustainability and integrating sustainable practices into those portfolios. It seems to be, at least the argument is, that's where the real impact can take place. So can you take us through what you've identified in terms of opportunities as it relates to impact and mission relative to the alternative space?
Sure, happy to do so. I think one of the primary characteristics of private investments, right, is just active operational management, whether it's a private equity firm executing a LBO, layering on tons of debt, laying off employees potentially. But it's really just getting involved at a granular level, right, with the company's strategies and operations. So I think for mission-aligned investors and impact investing really, as we define it, is just the societal and ecosystem change that is resulting from investment decisions, right? So I think there's a real intentionality where investors are looking to solve a specific problem with their capital. And so I think this is where the active ownership aspect of private investments, especially when one has direct ownership, perhaps you even have a board seat or some other advisory role. I think this is what it's advantageous about private markets for impact investors. So I think clearly there's an opportunity for direct impact via the underlying investments. Again, be it whether it's like affordable or workforce housing and real estate. The next promising climate tech startup in the venture space, or maybe investing in underrepresented founders, for example, and entrepreneurs. I think that is all very impactful and exactly what we and our mission-aligned clients are looking for. But I think another unique opportunity, I think in particular from my seat and an allocator's seat in particular, is that sharing best practices and knowledge that we are seeing from the leading managers, whether they're sustainability-oriented managers or not, right? So similar to the emerging manager business at Bivium, where we might work with emerging managers, share best practices, about how other successful firms have set up their back offices, for example, or third-party providers, which ones have been, other managers have recommended. I think we can do the same on the impact private side as well. And I think one interesting thing that I think me and my team have kind of worked through is just also identifying firms that don't necessarily talk about ESG or sustainability, but when you actually look at what they're investing in, it's actually very impactful, right? Because we know there's a lot of potential greenwashing just in the markets now. So when you find a manager who is kind of oblivious to the marketing, but what they're actually investing in is very impactful, I think it's kind of cool to find those diamonds in the rough. And those type of firms, they're unlikely to produce an impact report. They're probably not even measuring impact KPIs. But this is where we in our seat can be helpful by, again, sharing some of the best practices of the leading firms and helping them grow on their journey.
That's very helpful, Eric. Thank you for defining impact investing from your perspective. I think that's very helpful. And we alluded to this earlier as we start to talk about your current responsibilities and what Bivium is focused on. Could you take a step back and give us a sense of who Bivium is and how you define emerging managers in the context of your goals?
Sure. I think at Bivium, so it depends on the asset class, but I also think it depends on the client as well. So some clients might have a $2 billion definition. Some might be $5, but again, it depends on asset class. So I'll say generally, I think if a firm is probably $5 billion and below, especially outside of, let's say, small cap, where if you're $2 billion, you're probably at capacity or getting close to capacity. Outside of that, I would say probably 5 billion and below is probably a good general definition. But again, some clients might have slightly different definitions, themselves that we work with. On the private investment side, I would say generally, if it's a fund 4 and below, then I would still consider them an emerging manager.
That's great. I'm just curious, how early stage will you go? So will you seed managers without a track record? Is there, a minimum asset level that you look for? It sounds like it's good to understand your maximum threshold. I think that's usually the first question: is if I have $2 to $5 billion, do I qualify for the, for the search? But if I'm coming, with you with $25 million in friends and family for an emerging market equity strategy, what does early stage mean to you all?
Yeah, I think I think we would be potential first investors. I won't say that it happens often, but I think it has definitely happened where Bivium is one of the first investors, especially if you have a manager where you have a track record that we can easily reference, right? Or that's easily portable that we can look at. I think we have been some of the first dollars into a manager, even if it's just friends and family. So I would say, that is definitely a possibility, and we have definitely done that in the past.
Well, I mean, it's exciting for us to see you now taking all of these successful experiences that you've accumulated over your 22 years to Bivium. So you're now leading an investment due diligence team. I think there are 6 manager research professionals. Is that correct?
That's correct. Yep.
And how do you allocate, or how does each of those people spend their time in terms of coverage? Do you assign it through asset class, or are there different ways that you think about it?
Yeah, it's a small team. So everybody on the team is a generalist. So we do have folks who specialize and spend more of their time on particular areas of expertise. So for example, on the long-only equity side, Judy Liu has a lot of experience evaluating equity managers, so she spends a lion's share of her time there. But she's also been, getting up to speed on some private investments managers as well, as we've been, expanding our private investments capabilities. Same with Luan Dean on the team, on the equity side. Tung Ming, who is similarly experienced on the fixed income side, is also now covering kind of real estate and real assets as well on the private side. I personally focus on the private investments, overall, whether it's private equity, venture capital, real assets, and maybe private debt as well. But I couldn't possibly cover the universe without some of my help from Ellen Chu, who is one of the colleagues from our partners at West Fuller. So it's a generalist structure, but generally people will have some areas that they lean into or are most interested in learning about.
And do you mind just building on a little deeper, right? So let's kind of role play a little bit. You've got a fund manager or salesperson that reaches out to you. What does that due diligence process look like from an expectation standpoint? Because as an emerging manager, right, some of these meetings, they're first time meetings, from pitching their own product, right, filling out a DDQ for the first time. Just give our listeners a little sense of your process from underwriting an emerging manager.
Yeah, so I think our underwriting process, I would say, in terms of time, I think it can vary, and sometimes it really just kind of depends on client priorities. Like maybe there are particular priorities in a client portfolio that there's a hole where we're trying to fill. So like, we could be doing a search, and we could be doing that search relatively quickly. Or perhaps we had a manager blow up in our portfolio. We need to find a replacement. The time frame for situations like that could be relatively quick. I would say anywhere from 1 month to 1 to 3 months, let's say. But sometimes the due diligence process can take a lot longer, and I'm sure I think for the GPs and managers out there, sometimes it can be frustrating when you're dealing with the allocator community. But I think it's really because sometimes the portfolios are doing fine or they're doing well, and you don't have, whether it's a particular active search that needs to be going on, or the existing managers in your portfolio there's not a reason to find an upgrade or replacement, right? So in those cases, I think that the diligence process unfortunately sometimes takes months and potentially years until there's an opportunity. But for active searches, I would say it could be relatively quick, like 1 to 3 months. You also asked about the underwriting process. I would say the process that we use is generally like the manager research process that I think the 4P process or framework that I think most investment due diligence professionals use in the industry. So looking at people, philosophy, process, and then lastly performance, and then just using performance to validate what you were learning from the first three, right? People, philosophy, and process. But I think the process of investment due diligence doesn't really change meaningfully whether you're looking at a manager who invests a traditional way or a manager who is deeply integrating sustainability and impact. I think ultimately we're all trying to identify managers who can outperform or have some kind of edge, whatever that edge is. And I think in impact investing, we're spending a lot of time trying to identify authentic managers. That's one area that we spend a lot of time in. And I think, maybe just I'll give a couple of highlights of what I see from the leading sustainability-oriented firms. And some of these characteristics apply to, most impact firms, but I would say a few also just apply to the characteristics that you want to see from a well-run investment firm, just more broadly. On sort of like the firm and team, I think the things that we're looking for are firms that have total ESG alignment. So I think you'll find that the leading investment or the leading sustainability impact-oriented firms will have full buy-in from senior management on down and throughout the organization about integrating ESG analysis in their investment processes. We also want to see a ESG or impact analysis framework that kind of applies across all strategies of the firm, right? Whether that's regardless of sector or asset class. And I think that typically when you see managers with this trait, they're more often aligned. They're more often mission-aligned firms as opposed to firms that are just really solely applying client-directed negative screening, for example. Application of values, I think is something that we really spend a lot of time on too, because if you're trying to invest in an impact-oriented firm and they're looking for impactful companies or portfolio holdings, they should probably apply those progressive policies to how they run the business themselves as well, right? So having an inclusive environment, inclusive hiring practices. I think those are things that we like to see as well. And then lastly, just a couple of things more, just maybe just broader how we evaluate managers, at least from a team and firm, is just looking for business management and investment practices that are aligned for the long term, aligned for the long term view, right? I think this is a subjective category, but just trying to make sure that the business model is logical, is transparent, appropriately focused on investment management. These are these are the type of things that we like to see and see congruency throughout the organization.
That's helpful, Eric. Thank you very much. I'm just curious, where and when does the sourcing take place? I mean, one of the challenges with emerging managers in the emerging manager universe is finding them and them finding you. So when you think about the sourcing, aspect of your process, where are you uncovering these managers, and how does that process? What does that process look like in terms of sourcing versus kind of engaging with managers?
Yeah, that's a good question. I think in terms of sourcing emerging managers, I think we are, Bivium, I think we are in the fortunate position that where we've been in the business for over 20 years doing this. I think the firm was founded in 2002 to invest into, especially to invest in diverse and emerging managers. So I think because of that, I think we're lucky that a lot of our deal flow or managers actually just reach out to us. So I would say, a good chunk of our managers or new managers that we find are really just reach out to us, whether it's cold call through our email or just reach out to any one of us on our team at a conference. That's probably, if I had to estimate, probably about a third of new introductions. the lion's share, I would say over 50%, are definitely just through our own networks as well. Just all of us are pretty experienced at Vivium. We're a pretty senior investment team, so I think our own networks are good sources of new ideas. And then lastly, I would say our clients. Our clients probably maybe 10 to 15% of our new ideas come from clients, whether it's when we're onboarding a new client, could be a manager in their existing or legacy investment portfolio, or somebody that they have reached out in their own networks or heard about it, met at a dinner party. So those are the main sources of ideas. But generally, I think we are in a good position where we get a lot of inbounds as well.
Yeah, just a quick question. We talked a little bit about this, and you had touched on best practices. So when you think about emerging managers who are making that call for the first time, what are some of the overriding characteristics that you look for in terms of that engagement? So what are the things that you're hoping to hear from emerging managers as it relates to Bivium's clients and then the firm's overall investment philosophy and mission?
Erica Karp, the founder of my prior firm, Cornerstone Capital, used to say that Cornerstone was purpose-built for impact. And I think, as I mentioned before, I think a firm that has a well-articulated impact thesis or theory of change, I think those are the things that we generally look for, I think, or what I want to hear from a manager, right? So, I think the characteristics of leaders in the impact space, the sustainability impact space, is that they have a differentiated impact approach and that they view ESG analysis not just as a risk mitigator, but actually a driver of returns. And so I think for impact investors that want to generate measurable social returns, it's really critical to identify and hear that a manager talks about investment strategy that specifies how they're going to go about achieving the intended social outcome that they're trying to get after. I would say a couple of other things I would look for is in terms of their investment process, right? I mentioned having a well-articulated impact thesis or theory of change. I think we want to see managers who are thinking about ESG analysis, again, not just as negative screening, but as a driver of returns. We also want to see them use ESG analysis that is driven by their internal proprietary insights if possible, and less reliance on third-party data. Now, if you use third-party data like MSCI or Sustainalytics, that's great. But I think for leading impact firms, it really should play a supplemental role to your internal analysis. And then another thing that I'd like to look for and hear from managers is a comprehensive framework to act as informed or active and informed shareholders. And I think ideally this framework really is applicable across all the firm's various strategies and different asset classes. And we see a lot of leading firms that have strong stewardship and corporate engagement efforts. So I think these are some of the things that we look for, at Vivium as we're evaluating mission-aligned managers on behalf of our clients.
That's great. Thank you. Well, if we can pivot back to private markets, I know it's where you spend most of your time. And I was reading recently that over 60% of the capital in venture, for example, just thinking about private markets. So over 60% of the capital had gone to just 6% of the funds in the prior year. So it seems like it's still a high hurdle for investors to get behind those earliest investment managers, particularly in private markets. So do you see that data changing in the near to midterm for private market managers? Obviously, you're a specialist in early stage. Do you see, I guess I should say, the rest of the market catching on? Or what do you think needs to change in order for those statistics to increase?
That's a wonderful question, and something we'd all love to see change faster than slower. But what I would say is that I think I'm optimistic that the situation improves in the long term. But I do think that in the meantime, there continue to be real hurdles in the current system. I think those hurdles are, I would say, first and foremost, and I think this is timely with SVB and the regional banking crisis that's happening as we speak. But in times of crisis, there's always a flight to quality or perceived quality, right? So, for example, after GFC, we saw the largest hedge funds basically hoover up all the assets or inflows um, for at a much, relative to much smaller hedge funds, right? They benefited from the GFC. Or in the investment banking world, the bulge bracket firms, I think there was probably 8 to 10, maybe a few more, large bulge bracket global firms. But now it's probably 3 to 5. So I think in any crisis, and we'll see what happens with this, what the fallout is from this crisis. But it seems like the largest firms are always perceived as more stable organizations, and it's the old saying about no one gets fired for hiring IBM, right? So I think that's always a hurdle, I think, for smaller firms in general. The other kind of hurdle that we see and that is just out there is that few institutional investors will actually invest in new funds. You had asked a question about whether we would invest in first-time funds, and I think that Bivium is an outlier among allocators because I think it is human nature to want to follow what your peers and friends are doing, especially if you're swapping ideas at dinner parties. And there are sophisticated endowments out there who know the advantage of investing in new funds, but there are probably fewer investors like that than you actually than you think. Because it just takes a lot more time and effort to not only find these firms, be in the networks for these managers to find you or for you to find them, but also just to fully diligence them and get comfortable with these smaller organizations. So that's another hurdle. I think for large, sort of institutional type investors like pension plans or sovereign wealth funds, I think concentration limits, that's also a hurdle as well, right? Well, you have some pensions that do have emerging manager programs. I think the potentially frustrating part for managers is for small managers that there typically are some size hurdles because because of their size, they're allocating so much and they don't want to be, 50, 75% of a firm or even 30% of a firm's AUM. So I think that's a hurdle as well. But that being said, the sort of structural potential biases against small managers out of the way, I am observing and seeing changes in the industry that I think that make me more optimistic that in the longer term, smaller managers will get more of a shot. I think one example is the due diligence 2.0 commitment, of which Bivium is a signatory. Due diligence 2.0 commitment is just simply, it just means that outsourced CIOs like ourselves, investment consultants, and other investment due diligence professionals just take some practical steps to widen the aperture of the universe that you're looking at, right? So a couple of very practical steps among others, but one is just loosening track record minimum requirements, right? Often we see, in my prior firms, often needing to see at least 3 years or 5 years of performance before we even want to take a meeting or even consider them. So I think that's one. It's just loosening the track record minimums. But instead of requiring a minimum, why don't we ask the manager probing questions to evaluate the leadership teams on their past track records, whether they are easily portable or not. Just find some other ways to validate what they've done in the past and whether we think that is portable for the future. And then reassess, I think AUM as a risk metric. I think that's another one that allocators can easily take a practical way to widen the aperture. And looking, rather than just looking at AUM as a kind of sort of proxy for risk or how, the riskiness of a business, ask more probing questions about how is the business being financed? How much runway or reserves has the GP or manager built up in case in a rainy day scenario? It's kind of like taking a private equity approach to evaluating managers. But I would say those are a couple of practical steps that allocators can take. But I think that seeing the number of signatories for due diligence 2.0, I am cautiously optimistic that we are moving in the right direction in the industry.
Yeah, and everything you've gone through, Eric, so far is great advice for an emerging manager, whether they are new or small, right? They could be the best investor in their specific asset class, but you're giving insight and clear insight into how to run a business, right? And you're thinking about not only just a potential investment on behalf of your client, but also a true partnership with this business as they continue to hopefully perform well, but also as you grow, they can grow alongside you. So, I mean, working with a Bivium, it sounds like it's more than just here's a product and put on your shelf. It's a true partnership and see each other grow at the same time, which is great.
Yeah, absolutely. And I think part of that partnership is, to your point, kind of giving feedback, positive or negative. But also, I think from our standpoint, sometimes, once we have that initial relationship, maybe even seeding new strategies or customizing strategies for us and our clients, that's also an avenue for partnership as well.
Well, you've mentioned times of crisis a couple times, so it wouldn't be, I think, a conversation today if we didn't talk about risk management and the way that you think about risk management as it relates to what's been going on in the markets, specifically with financial institutions. But are there any lessons or insights you've taken out of the 2022, where arguably most of diversification broke down, probably other than your book, Eric, in private markets, and now into 2023? Has anything changed for you in terms of how you think about risk management from a manager research perspective?
Yeah, that's it's a timely question, and I think my takeaway, I think, from recent events, and in particular with the SVB situation, is that ESG analysis is actually probably more important than ever, I think, because as I mentioned before, I think ESG analysis should be supplementing traditional financial analysis. And so, even though ESG scoring is not perfect, but I do think that it can reveal core issues at a company. So, for example, with SVB, we're reading in the press these days that, well, clearly there were several dominoes that happened in order for them that led to their downfall. But chief among them is, I think, poor governance, right? It sounds like they didn't have a chief risk officer for over a year. So what does that say in terms of the firm's governance? So when I think about ESG, and each letter individually, among the E, S, and G, I would say governance is the first among equals. And in many ways, I think governance is kind of like the forgotten letter within ESG, because a lot of the corporate platitudes that we hear about, helping the environment, or helping with social justice issues, and how companies are doing their part on that front, and also obviously the anti-ESG pushback that we have been seeing, sort of in political circles as well. But I would say if a company's E and S scores are stellar, you will fail if you fail on the governance pillar, because governance really, what is governance, right? It just really comes from qualified people making informed decisions and building a strong, cohesive culture to execute on that company's strategy, whether it's whatever that company's strategy is, right? So quality governance really just means understanding the cost of your externalities and risk, and then maybe having to adjust your business model accordingly. So I think when I look at SVB, for example, when I look at the ESG ratings for SVB across the main providers like MSCI, Sustainalytics, S&P Global, and I think Refinitiv it's interesting to see that SVB actually didn't score that high on governance, and that I would say, again, that doesn't mean that just because the company scores poorly that they're going to fail. I think that's not the lesson. But I think the lesson is that while ESG scores won't tell you the exact failure point of a company, what they can do is direct the analyst or PM to do more work, on a certain area, or try to uncover material information that that might lead to something interesting. So again, I think SVB was a good example where if you dig a little deeper, you see that they didn't have a chief risk officer. And I think the bad governance that implies is certainly a material issue.
Yeah, Eric, it's quite obvious that the impact ESG component at Bivium is coming through quite clear in this conversation. How easy is it for you, and I think we've talked about this on prior podcasts, to sniff out the marketing of ESG compared to a strategy or firm that is truly impact oriented or ESG focused?
It just takes time and experience, I think. So I would say it's not hard, but I think, again, it just takes time and experience. I would say in my position, for me personally, I think I've had the privilege of not only working at Bivium now, having exposure to emerging managers very early in my career, but I also worked at a firm, my last firm, Cornerstone Capital, that was 100% focused on sustainability impact. So I was able to meet, hundreds of managers, maybe even thousands of managers, who claim to be doing sustainability impact. I would say that, because of, all those meetings that I've done, I think I've just kind of developed a heuristic in my mind of what is a manager that is going to be mission aligned and therefore a client that would fit with our client portfolio, in our client portfolios. I don't know if I could really quantify it, but I would say that when you talk to a manager who is truly mission aligned, you look at their presentation materials, the way they present their strategy, the way they talk about the impact that they are trying to achieve. I think it just comes through just from not only looking at presentation materials, hearing them talk about their strategy. I think it's just you just kind of know, I guess, when the manager is a lot more intentional about what they're trying to achieve with their investment strategy versus XYZ firm just slapping an ESG label on. So I think that's kind of I think it just developed through years of doing manager research meetings, and more recently, focus on sustainability and impact.
And then on the flip side, right, is you've got strategies that might have an ESG component, but that's not their core philosophy, right? Or they're thinking about the impact and what they're doing for the good of the world, but really they've got their investment strategy philosophy. For an emerging manager, would you look at a new or smaller manager that isn't so focused on ESG? And they'll acknowledge it and say, hey, it's part of our process, but it's not core to what we do. Or for our listeners, right, it's we need kind of dedicated impact alignment for our clients.
Yeah, at Bivium we would, because while our newer impact OCIO business is more focused on that mission alignment and sustainability impact, we do have our emerging manager business where that is the case. I think that business or those clients are more focused on just emerging firms and diverse firms that are outperforming, whether they are integrating sustainability or not. If they are, I think great. If not, it's not a disqualifier either. So I think, we do have kind of two lines of business. One is, again, the outsourced CIO business, a bit more mission aligned, and our long-standing emerging manager business, which has a slightly different focus.
Awesome. That's great to hear.
Thanks, Eric. That's really helpful. Well, maybe as a parting question, we do have a number of emerging managers who tune into the show that are part of our audience. So I think they would be very curious from your seat in terms of, what activity is going on at the firm. What asset classes are you currently focused on? Are there any areas in particular in the market that are, you're gravitating towards at the moment?
Yeah, I think the areas that we're gravitating towards are kind of, right now driven by where we think that there are market opportunities, but also areas where I think our clients are underweight. So I think in the OCIO business, that is, real estate or real estate and real assets type of investments. And in particular for mission aligned clients, that would be like affordable housing, for example, sustainable infrastructure. Those have been the areas that we've been more focused on. I would say, I think on the private equity and venture side, I've also met quite a few interesting opportunities more recently, just like with venture firms. I think that dry powder is always an issue for clients, and sometimes they might be shy, especially now with the market tumult, to allocate to venture, and many clients actually are over allocated as well. But I do think that when there is market volatility, this is actually the time to make sure that you continue to allocate to these early stage companies, because if you look at the vintage years that did well over the last two crises, whether it's after the tech crisis in early 2000s or after the GFC, the vintages after these crises always tend to have some of the best or most well-known companies come out of them. So I think those real assets and then selected opportunities on the private investment side.
All right, we're back. I hope you guys enjoyed that interview. We know we did. Tim, why don't you just go through some of the key takeaways? We're going to kind of go rapid fire here. We're going to send this out as well. Key takeaways from that interview, because it really was spectacular.
Yeah, I think first and foremost, right, when you hear about an emerging manager program, right, there's a max on assets under management. Theirs is at $5 billion. So that's really high compared to some others that we've gotten to know over the years. So even some larger strategies, if you will, diverse equity and inclusion, impact, ESG, massive takeaway, huge focus of Bivium. So even if you are a larger firm, in our opinion, $4 or $5 billion, it's still worth a phone call.
You're casting a wide net. I mean, they're giving a lot of opportunity to emerging managers.
Yeah.
And I would also say just the client-specific needs too, right? So even though maybe within their explicit parameters that they put out there, keep those conversations going, because you just don't know if there's going to be a client-specific request that comes along where you would fit those parameters.
Yeah. I also liked hearing personally, because we market strategies, both long-only equity, traditional long-only equity, and private alternatives. They look at all asset classes. We've had Adam Chopin from Exponents here on a prior emerging manager growth show. They only look at long-only, right? So it's another phone call for anyone on the private side. Bivium is open to the private space.
Are you going to run through the programs?
Yeah, happy to do so. Just one key topic that they didn't touch on, which I think is important for listeners to understand, is the emerging manager programs from a fee standpoint.
Yeah.
Right. So as you know, a lot of them do work with large state pension plans. Lacers is one that used to work with emerging manager program, does a lot of it in-house. But from the long-only side, I think it is from an expectation standpoint. When you get in that conversation, they will want to drill down on fees and actually have a lower fee for that allocation, because they are allocating in size. And as Eric talked about it, it's a partnership. It's not just an allocation. So they're going to work with you and help you grow over time. So it could go anywhere from, if you're 100 basis points in long only, down to 15 to 20 basis points. So
or be creative, right? If you're going to talk about performance fees, even for long only, like that's something they will entertain and talk through.
And this is why it's important that you call on Vanguard and others, because within that program, they might only charge 8 basis points. They might give you $3 billion, which they've done for the manager they knew before. And basically they're saying, we're putting you in business and giving you the assets to go grow.
Yes.
Right.
Exactly.
And so that's the same situation here. It is a partnership in that sense.
Yep.
But it's not, these aren't programs that are going to make you rich. These are programs that are going to put you on the map.
Yeah.
Correct. Yeah.
So we thought, just to kind of round out the call on the emerging manager programs, list out a few others that we know of that are specific to emerging managers. So you've got Exponents here in Philadelphia, that's formerly FIS Group. Great interview from Adam Chopin on a prior show. You have Addicts in Chicago, Legato in San Francisco, Leading Edge in San Francisco, obviously Bivium in San Francisco. And then in New York City, you have Appomattox and Stable Asset Management. So all of this information and content we do have housed in Dakota Marketplace. So if you are...
We did get that question, by the way.
Oh, we did?
Yeah, we got the question. Is there a checkbox in Dakota Marketplace if they will utilize an emerging manager? The answer is yes.
Yeah. Well, I think that to even dig deeper into that question, we have the emerging manager programs, but also across all channels, right? So even looking at the RIAs or even some of the banks and broker-dealers, obviously consultants, but the RIAs specifically, if they invest in an emerging manager, we do have that checkbox in Marketplace.
Yeah.
Cool. Any parting comments? I know on the front end of the show, we went pretty deep on encouraging everybody to get the meetings, get out and see people. Allocations are coming. They're actually coming right now. But the news is actually better. I know it's hard, but it's actually better than you think.
No, I think you touched on all of it.
Great. Our next show will be April 24th at 1 o'clock. Can't wait to see you there, and thanks so much for joining. Hello, everyone. Just wanted to say thanks for watching. Hope you enjoyed the show. One thing that I think you do know is all of this information that we covered exists in Dakota Marketplace, our institutional investor database. Even this show that we just cut will end up in Dakota Marketplace so you can view it. And if you're not a member, we would love to show you the platform. Just simply go to our website and get a free trial of Dakota Marketplace.